You want a custom home in a great neighborhood, but paying the premium for new construction requires massive upfront capital. You can bypass that premium using a Fannie Mae Homestyle Renovation Loan. It's a single-close mortgage that finances both the purchase of a property and the cost of a complete remodel at the exact same time. You secure a highly leveraged property, tap into major long-term tax advantages, and keep your initial out-of-pocket cash to an absolute minimum. But the trade-off here is purely operational. When you take out this loan, you tie the survival of your mortgage directly to your general contractor's schedule. The bank enforces incredibly strict deadlines for the construction to finish. If your crew falls behind schedule and you miss that deadline, your loan goes into immediate default. It functions as a strict project management test. Your contractor holds the leverage, and their efficiency dictates whether you keep the house. The baseline barrier to entry is low. The bank requires a minimum credit score of just 620 to qualify. But once you meet that score, the amount of cash you need to bring to the table and the type of property you can buy are dictated entirely by how you plan to use the building. This decision tree shows how intent dictates cost. Primary residences get the absolute lowest option, requiring just 3 to 5% down and maximum flexibility, allowing single-family up to 4-unit buildings. If you are buying a vacation property or second home, the capital requirement doubles. You have to put down 10%. Real estate investors face the tightest constraints, requiring a 15% down payment. Investors are also cut off from multifamily properties entirely, strictly limited to single-family homes, condos, or townhouses. To secure the lowest out-of-pocket costs and the right to buy a multi-unit building, you have to pack your bags and move into the finished project. Next, we have to look at the budget mechanics. The bank limits your total renovation costs to 75% of what the property will be worth after the work is completed. This chart shows how that cap functions. If the appraiser determines the home will be worth $400,000 post-renovation, your absolute maximum construction budget is capped at $300,000. You can use that budget to level an entire dilapidated property, leaving only the original concrete foundation intact. By legally keeping that original foundation, Molmokel County cannot classify your project as new construction. This bar chart compares property tax bills. A true new construction home might reassess your taxes at $20,000 a year. But by using the teardown strategy and preserving the foundation, your taxes could be assessed at just $8,000. You keep the existing footprint of the old house, and in exchange, you generate $12,000 in annual cash flow savings. Giving up the ability to expand the home's foundation is the specific trade-off required to secure permanent, long-term tax savings. You cannot live in a property during heavy structural construction, which creates an immediate cash flow problem for the borrower. To solve this, the loan allows you to roll up to 6 months of mortgage payments directly into the total financing amount. If you close in June, you aren't paying out of pocket for a house you can't legally inhabit. Your first actual payment might not hit until February of the following year. The bank also requires a mandatory 10 to 15% contingency fund built into the loan to cover unexpected material costs or structural surprises. If your contractor hits their targets and those emergency funds go unused, the bank automatically applies the balance as a principal reduction to your mortgage. But you are racing against a rigid clock. You have exactly 15 months to reach final completion. If your contractor leaves the job unfinished past month 15, you officially enter default. The bank will force you to refinance the mortgage under extremely unfavorable, expensive conditions. The bank is willing to minimize your required down payment, but they shift the operational risk onto your contractor's ability to deliver on time. This quadrant chart shows who should use this tool. The Homestyle loan trades upfront capital for intensive project management. Tight on cash but trust a fast contractor, you are the ideal user. High capital but an untested team presents a severe default risk. Vetting the crew swinging the hammers is just as vital to your financial safety as reviewing the bank's underwriting terms. By keeping that original foundation intact, you secure a highly leveraged property and dodge thousands in new construction property taxes. Your success with this loan is ultimately decided long before the first wall is torn down. You win or lose during the contractor interview.